Hello, everyone. Welcome to part 4 of our webinar series. Tonight, I'm Peter Kinch, and with me is Brian from Centurion Asset Management. Brian, how you doing tonight?
I'm doing fine, thank you.
Fantastic. Very excited to hear. If you've been on these calls before, as you know, we like to do kind of a radio show format here. So Brian and I are going to go bouncing back and forth on this call, talking about Centurion Asset Management. So, we can learn more about what they have in terms of a REIT and a REOT. But before I dive into that, as I've mentioned in the past, with any of the products, companies, or opportunities that we share here through this webinar series, I want to emphasize that it's about offering you tools in the tool belt so that you can fit it into an overall plan. I'm not going to go into some of the things that I've talked about in previous webinars about your personal financial landscape and the importance of putting that together. I'd recommend anybody who has not done that already, refer back to webinar number 1. If you don't have access to that or you haven't seen the very first webinar we did, just send me an email. I'll send you a copy of that webinar, and that will bring you up to speed in terms of the process. And again, a lot of you know me as Peter Kinch, the mortgage guy, working as a mortgage broker. Yes, I still am a mortgage broker, but in addition to that, and I emphasize in addition to that, I'm now Vice President with TriView Capital, and TriView Capital is a gatekeeper in the world of exempt market products and private equity. We are a private equity boutique dealer. And one of the things we do is a lot of due diligence and vetting of the wide assortment of companies out there who offer private equity opportunities, and one of those companies is Centurion Asset Management. And tonight, of course, we have Brian Fraser on the line with us, and again, welcome, Brian. Brian, maybe you can start by telling us a little bit about who you are and a little bit about Centurion Asset Management.
Definitely. Thank you, Peter. First of all, I'd like to thank everyone for taking the time this evening to take part of in this webinar. And Peter, I've heard some great things about your the format you run. So thank you very much for asking for Centurion to join you today with your investors. So who are we at Centurion? Centurion Asset Management is a Canadian-based company. We're based out of Toronto. And what makes us unique is that we offer a growing portfolio of private investment products, mortgage financing, apartment and student housing property management. As a whole, Centurion, we're not too big, or nor are we too small. We basically own and manage approximately $1 billion in total assets at Centurion, which is essentially can be.
Did you say 1 billion, right?
1 billion, yeah. $1 billion.
So for most people, that would be big.
Okay, thanks.
It's all relative, isn't it?
Yeah, it is. Now that 1 billion is can be basically is split up between 2 of our investment strategies. And what I love about Centurion is that our portfolios are very simple, they're transparent, and they're focused strategies. They're very easy to understand. For example, our flagship fund, is the Centurion Apartment REIT. It's been around in existence since around 2006 when we were a limited partnership. We converted to a mutual fund trust in 2009 to the current day. It consists of 45 quality multi-residential rental properties across 16 communities, so basically 16 cities across Canada. What I love about the REIT is that it's very easy to understand. We basically buy apartments and student housing on a national scale. We upgrade these properties, and after expenses, we do pay out a very nice tax-efficient distribution back to the investor.
Okay, well, sorry to interrupt you, we're going to circle back and go into more detail about that. I just want to emphasize the fact that, a lot of people on this call tonight probably are real estate investors themselves. They might have a portfolio of actual hard assets, and looking at expanding that, and maybe looking at maybe looking at their TFSAs or RSP. So your products are TFSA and RSP eligible, correct?
Yes, they are, both of them.
Yeah, fantastic. And no, sorry, I interrupted you. The second product is?
the Centurion Real Estate Opportunities Trust. One of the things we do well here at Centurion, we have acronyms for everything we do. So the Centurion Real Estate Opportunities Trust is otherwise known as the REOT, R-E-O-T. And this is a unique strategy that was launched back in October 2014. And in a little over a year and a half, we are currently sitting around $150 million in assets. So we've been very successful in raising a lot of capital from investors throughout Canada. What this strategy is all about is basically it is a diversified portfolio of mortgages and opportunistic real estate development projects. And essentially it is a lending/development fund.
I find that one fascinating because in my world I'm familiar with MICs, Mortgage Investment Corporations, mortgage lending. Obviously, the last webinar we had was with AP Capital, which was a MIC. So a lot of the listeners on this call, again, have been acquainted with what a MIC is. So it's going to be interesting to dive into what the Real Estate Opportunities Trust is and what the similarities between that and a MIC. And that, well, what's similar and what's different. And also what's interesting to note is that the way the income that you earn in your REIT is different than the REIT versus the REOT. And there's some tax planning that could come into play in terms of which one you choose, correct?
That is correct. The REIT is very tax efficient. It is good for open money, whereas with the REOT, our distributions are mainly treated as interest income, and which is best suited for a sheltered product like a TFSA, RESP, as well as an RSP.
Excellent. So listen, Brian, that's a great overview of the two products. We're going to dive into that in case somebody on the line sitting there going, oh my God, I didn't quite catch that. Don't worry. We're going to dive into what a REIT is specifically. We're going to go into some details about that. We're going to talk about the REIT. I just want to say from a technical perspective, I'm going to be controlling the clicker here. So Brian, if there's any slide you want to go to, just tell me which slide you'd like me to move to, and I can bring that up on the screen for everyone. And the flip side is, if anyone has a question throughout the night, don't hesitate to use the box there. If you're on your menu items there, you should have questions. You click on that, type in your question, and I will do my best to address that throughout the course of this webinar. Now, Brian, one of the things I've got the slide up right now saying Centurion, who are we? You've talked about the fact that you guys have $1 billion in total assets, and I like your growing portfolio, simple, transparent, and focused strategies. You talked about the REIT, the REOT. You know what? One of the things that I don't see up here, and I know it's in the appendix, but the gentleman who started Centurion, I think before we dive into the products, I'd like to know a little bit about the people behind it. And Greg I'm hesitant to mispronounce his last name, Greg Roman. Is that correct?
Roman.
Roman. Okay, good.
That's right. Yeah.
Very close. Very close. Tell me a little bit about Greg, because I had the great opportunity of meeting Greg, and I've heard a little bit about his history and his background. And if you're looking at any investment, it's as much about the quality of the people as it is about the quality of the product or the investment itself. So I'd like you to touch a little bit on Greg's background, because I think it's very important. And I'm going to pull up his. As you say that, I'll pull up his bio here, Biographies of the Trustees. Greg Roman, there you go, president of the company. Tell us a little bit about Greg.
Yeah, so in a nutshell, I'm at Centurion because of Greg. As Peter was mentioning, behind any great strategy, you have to have a management team that has the ability to execute properly. And Greg is very well known on Bay Street. He is known as a gentleman who runs a very structured and disciplined firm. Greg is he's very unique in a positive way. Greg, what I love about Greg is that when he looks at real estate, it's in the eyes of a trader. And why do I say that? Greg actually started his career as an interest rate derivatives trader for Citibank in Singapore. And one of the main...
And he probably just lost a lot of people with that. Yeah. In terms of what an interest rate derivatives trader is.
Exactly.
Yeah.
The whole mantra behind an interest rate derivatives trader, or any trader at the end of the day, is make money, don't lose money. And so that's basically how he applies in each and every facet of the job at Centurion. It's all about, the four main premises that Greg follows. One is capital preservation first, so preserve the capital of the investor. 2, focus on yield. 3, focus on growth. And 4th, tax efficiency. So behind everything Greg does is all about make money and don't lose money. So as I mentioned before, Greg was an interest rate derivatives trader for Citibank in Singapore. He moved back to Canada, and he actually ran the, I guess you can call it the emerging market derivatives desk for Citibank and AIG in both Toronto and New York. So he does bring this discipline of, again, capital preservation, making money, don't lose money for the investor. He was retired, believe it or not, at the age of 31. He was very successful in what he did. And so apparently over a period of time when he was at home, they had him and his wife had a young daughter. He was bugging his wife too much, and she basically said, go and create a company, do something, you're bothering me. So Greg decided back in 2003 to create a firm called Centurion. And basically where he just invested his money into buying apartment buildings, upgrading them, and selling them. Soon enough, friends and family started providing him with capital, and then he realized now he has to do a lot of reporting, T3 slips, and so he decided to essentially convert his company into a limited partnership from 2006 to 2009. And here we are, 2016, going from 0 assets to definitely over $1 billion in assets. So yeah, that's what's unique about Greg.
Yeah, that would qualify as successful.
Very successful gentleman, 46 years old, 25 years in the financial markets, over 20 years in residential real estate. And the key to Greg, too, is that he's also is supported by a very senior management team, as well independent boards on both the REIT and the REOT.
Yeah, and I have to say, I know it's hard for you to say this, but what struck me in meeting him was, and I'm not sure how to put it in words, kind of a sense of a humble gentleman, not loud and boastful, but also someone who definitely, there's a sense of integrity behind what he does.
Exactly. One of the things I failed to mention in the opening is Greg takes the firm very seriously, takes the firm, managing investors' assets is his #1 focus here. And to kind of give you an added level of credibility in what we do at Centurion with Greg behind the helm here, is we manage money not only on behalf of retail investors, but we also manage money on behalf of institutional investors. And when you can actually manage money for institutional investors, that means that you've been vetted by some of the most rigorous process when it comes to due diligence. For example, in 2012 it was, the Teachers Pension Plan from Concordia was looking at reducing their exposure to a lot of public equities and adding private capital to their portfolio to reduce volatility. They identified 50 private firms in the country. They narrowed it down to 5, invested into 4, and after 18 months of due diligence, they invested $37 million into the Centurion Apartment REIT in 2013.
Wow.
So
now we have to assume that they have we have to assume they have a pretty extensive due diligence process before they randomly pick somebody to drop $37 million to.
You got it, Peter. I mean, they interviewed Greg, interviewed his senior management team, the independent board of trustees, spoke to people on Bay Street, went through our audited reports, our offering memorandum. It was a long process, but definitely well rewarded for it.
Wow. That's huge. And again, I know for a lot of people understand what you mean when you say institutional versus retail investor, but can you just elaborate a little bit with some examples? What's an example of institutional versus retail?
Yeah, so for example, our very own Canadian pension plan has been basically investing into a lot of private capital since 2008. Endowment funds, for example, can be considered institutional. So endowment funds from Yale, Harvard are another good example. University of Toronto, UBC, they all have endowment funds. And so they all are looking for alternative strategies that is a nice way to decorrelate against market volatility. And so, yeah, once you can say you manage money on behalf of the institutional investors, again, I think the credibility of our strategies go up a couple levels.
Right, and of course, retail would be the average consumer who typically invests into pension funds and different things. If you're looking to put so what's the minimum in the REIT?
Minimum investment?
Yeah.
5,000.
5,000. So
yeah,
let's just say somebody wanted to put anywhere between $5,000 and $100,000 into versus a TFSA or their RSP, they would be considered what you call the retail investor.
Retail,
so,
exactly.
Just clarifying the definitions for folks out there on the line. And again, that's huge when, really as investors at the retail level, sometimes it's very difficult to know what to put your money into. I mean, we work really hard for our money. And how do I know whether I can, trust this guy, and that guy, or that gal? And at the end of the day, everybody talks a good talk, but I think that one of the things that's really important to look at is, we have a limited, I don't want to say skill set, but quite often for the average investor, there's a limitation in terms of our ability to do full-on due diligence. So to me, that's huge to know that pension funds and endowment funds have done that due diligence, because I can certainly imagine that their level of due diligence would be much greater than my ability.
I think so. In mine,
yeah. So let's go back to, I'm on the screen now, why private investments? What do the investors look for? Slide 6.
I think if you take a look at the cross-section of our investors at Centurion that have invested in both the REIT and per se their REOT, is that we are basically, our target investors are generally those investors that are either retired or pre-retired that have specific needs. It could be capital preservation, they're looking for steady, stable monthly distribution, growth potential, tax advantage income. As well, they're looking to diversify their portfolio away from equities, because a lot of investors' portfolios these days are still overweight in equities. And so, when you take a look at what private investments offer, they do touch upon, I think these 5 specific needs that can be that can be attributed to one or all to investors, right? So I think private investment does offer, the benefits of capital preservation and distributions and some growth.
Well, I would imagine you probably hit when you talk capital preservation, monthly income and growth. I mean, everybody's looking for some form of all of that, right? Diversification, tax advantage. Part of the integrating this with your tax planning, your estate planning, your retirement planning. And when you talk about the equities, again, I just want to clarify for everyone listening, we have talked about this in previous webinars. The majority of consumers, investors, RSPs, typically walk down to a bank, sit down with a financial planner, a bank rep typically, or it could be someone who's part of an IROC firm, whether it be a financial planner, Raymond James, Wood Gundy, Dominion Securities, Scotia McLeod, etc. The bulk of that money gets invested in some form of mutual funds typically. I don't know, and Brian, I don't know if you know these numbers, but I'd be curious. I'm just thinking out loud here. I'd be curious to know what percentage of Canadians' investable assets are just put into mutual funds.
I have a strong feeling it's, for a typical retail investor, the vast majority, great percentage, I would have to say.
I wouldn't be surprised if that number is cresting 80, 90%. It'd be interesting to do that. Note to self, I'll try to find what that number is. But, when you think about that, what level of real deep analysis is going into that? And I'm not knocking the mutual funds. Don't get me wrong. If you're sitting there going, I really like my mutual fund, but there are some hidden fees into mutual funds, and some are fantastic. Some outperform the markets. If you listen to Anthony Robbins' most recent book, apparently 96% of them don't outperform the markets. But the real thing here is also creating a bit of a diversification, because I think that word gets bandied about a lot. Again, if you listen to some of the previous webinars I've done, we talked about the Yale Endowment Fund, which is considered to be one of the most successful performing funds in the marketplace. And I don't have the numbers off the top of my head here, but it certainly is not 100% vested in public market products. They have a strong percentage of the Yale Endowment Fund is in real estate and in private equity, and of course also in equities. When we say equities, by the way, we mean the publicly traded stocks and bonds. One of the things I found, Brian, and maybe you can address your experience with this, is there's been a growing, certainly from the institutional investors, the pension funds, the insurance companies, the endowment funds of the world are really looking, when they talk about diversification, they're not talking about expanding into 10 different stocks. They're talking about expanding outside of the publicly traded markets.
That's correct. I mean, if you look at the traditional way we have diversified our portfolio, it has been maybe geographical location, market cap, so small, mid, large cap companies, different management styles. But I think one of the key areas that we've been missing when we truly talk about diversifying portfolios is adding in asset classes that are not correlated to public markets. Because when the tide rises, everything rises in turn, and when the tide retreats, then everything sinks at the same time. So it's nice to have a diversified portfolio that's not correlated to one another. Actually, there was a study that I was reading recently from BlackRock, which is probably the largest asset manager in the world, and they took a look at a typical mutual balanced fund that is 60% equity and 40% fixed income, and they compared it to a portfolio that was 100% equity. And over a 15-year period, they had a correlation of almost 1, which means that there is no diversification with a balanced fund in the long term.
Wow.
And,
so we you hear these terms, balanced fund, all the time. The study would suggest that they're not really balanced, or certainly not diversified.
Because they're correlated. They're publicly, the fixed income and the equity is somewhat linked to the markets, right? So they are correlated to one another.
So if you're listening to this at home, if you got a pen and paper, write the term down: non-correlating assets. And whether you decide that this is something for you to invest in or not, I can't emphasize enough the importance in the overall picture of your real estate your investment portfolio, which could include a component of real estate, a component of private equity, and a component of publicly traded products. I can't emphasize enough the importance of having non-correlating assets, and I think that's what you're addressing with that. From what you were saying, Brian.
Correct.
On slide 7 here, we're looking at the riskier assets. I'm not a big fan of charts, so maybe you can tell me what we're looking at in this chart on page 7 of the slide.
Sure. What this chart highlights and illustrates is that as investors, you and I, everyone on the call, we're facing 2 major challenges. One is a very volatile market. Since the beginning of the year, the markets have been up and down, a lot of roller coaster peaks and valleys. And so if you are an investor and you're looking to generate growth in your portfolio or looking to generate yield in your portfolio from the public markets, it is a very challenging time because you got to be, you have to handle the high level of risk. So the markets over the long term have proven to be an upward trending. They have delivered returns. However, you got to be able to take the good and the bad. The good is, you can maybe get some good growth in the markets as well and pick up some yield. However, you will be taking a lot of volatility. On the flip side, if you are totally risk averse and you have to rely on looking at the GICs because you want zero market volatility, you can go to a bank these days or a credit union and pick up a 5-year GIC paying you 1.5%. 1.5. And
wow.
Once you factor in taxes and you factor in inflation, there's a chance you actually might have lost money. And so that's some of the challenges that investors are facing these days. A, the volatile markets. As well, we're currently in an extremely low interest rate environment, and there's no signs that that is going to change going, at least for a mid to long term.
Yeah, and you know, one of the things that's really important, I had a conversation with a gentleman this morning who's looking, just sold a property here in the Lower Mainland, made some good coin, but now moving into retirement, and he needs income in this particular scenario. So, you know, sometimes when you look at the volatility that you're showing on the screen there, and that's the, if I'm not mistaken, basically charts out the S&P and TSX Composite Index. And you look at that volatility up and down of the yo-yo, so to speak, and it'd be interesting if you took just a look at that since January. It'd be even more scary to look at. But that's what we refer to when we talk about volatility, up and down. And it's like buying real estate. If you buy if you're doing a long-term buy and hold, you buy something today, then the value tomorrow is largely irrelevant unless you're planning to sell. So the value between the date you buy and the date you sell really has no bearing on anything. And the stock market is similar. So if you got a long horizon of 20 years and you're willing to just ride out the ebbs and flows and the volatility that comes with it, but over the course of that 20 years, you're going to see a percentage growth. So the market is similar to the stock market is similar to the real estate market in that. But one of the things Warren Buffett talks about is that you'd rather have a solid, steady 6 to 8% growth continuously over 20 years rather than chasing high returns, for example, getting 20% one year and then losing 15% the next. I think there's actually been a study showing, and Brian, maybe you can address this, where solid, steady 6 to 8% consistent over time outperforms portfolios that get plus 20 then minus 15.
Exactly. You know, it's one of the analogies we hear a lot is, you know, we're heading into the baseball season now, and I'm a big Blue Jays fan. But
Yeah.
the goal of your investments, if you can find various investment strategies that can hit those singles and doubles, giving you that 6 to 8% rate of return over the long term, that's how you're going to succeed in these volatile markets. And in fact, Greg was commenting that one should expect equity markets over the next couple of years should be returning anywhere between 4 to 6% on the top end. And so it's, I think we have to reduce our expectations to what equity markets are going to deliver because the high level of volatility, and take a look at other products out there that can give you the numbers you're looking for to help you achieve your financial objectives.
Well, you know, I had a conversation with a client the other day, and it was like, wow, the stock market's crashing, and it's done terrible. I've lost money in the stock market, and I don't want to invest in Vancouver because it's a bubble about to burst. And Alberta, the oil's got, you know, you could look at wherever you want to turn your sights, you can get really depressed these days, depending on what headlines you're reading. And, you know, one of the things that I found is that the answer to all of it, for me, is don't put all your eggs in one basket, and that means don't just put all your eggs into a mutual fund blindly. Get some true diversification, non-correlating assets. There we go with that term again. And so I think the REIT is a fantastic example of that. So, you know, that brings us back to talking about the REIT. And now I want you to dive in and get into what is a REIT exactly, you know, what you guys do, what's the difference between your REIT and being a private REIT and what a public REIT is. And, you know, and also just a quick, maybe you should touch on this almost up front, or maybe talk about what a REIT is, and we'll talk about the fact that right now, temporarily, you guys are completely sold out in terms of what's available, but we'll get back to that one, okay? So, you know, I'm on page 9 on the slides here. Talk to me about what a REIT is, first of all.
Sure. So, you know, a REIT essentially is defined as a company that owns income-producing real estate. So our Centurion apartment REIT is a diversified portfolio of rental apartments and student housing properties in Canada. So we are a private REIT investing in apartment buildings as well. We are the only REIT, whether it's private or public, investing in student housing. In fact, we are the largest owners of student housing outside the universities in Canada.
Wow, and student housing, as we all know, provides a higher level of income than just your regular typical apartment buildings.
That is correct. You generally will generate a higher yield per square footage with student housing than you would do with a, you know, a single suite in an apartment.
So again, you got income, investment growth, capital preservation, and inflation hedge. Explain, what do you mean by inflation hedge?
Generally, when it's one of the reasons why investors like investing into private real estate investments, and that can be mixed, and that can be private REITs, is because as the chart illustrates, you can generate income. There's opportunity for growth, definitely capital preservation, but our rent tends to rise with inflation. And so you are actually protecting purchasing power when you do purchase into let's say a REIT, for example. So as if inflation was to increase 1.5%, then we do have an opportunity to also index our rent also 1.5%. So you're not losing the value of your dollar.
Right, and because you own the asset, if the asset itself is going up, do the investors directly or indirectly participate in that asset appreciation?
It definitely. So our objective with the REIT is, for example, we want to target a yield close to 7%. So right now our yield is 6.69%, very attractive. But as well, we want to grow our unit price of our REIT anywhere between 2 to 5% each and every year. As a nice way of hedging against inflation and to protect purchasing power. And so you, as an investor, you do get to participate, let's say possibly in the increased value of the properties in the portfolio.
Fantastic. Okay, so let's talk about real estate types on slide 10 here.
So when you take a look at real estate, it's very it is a very diverse sector, and you'll notice there's a handful of subsectors within real estate: commercial, industrial, retail, residential, single-family homes, condos, and I have highlighted multi-residential. And multi-residential actually can be further subdivided into apartments, which is a core focus for us, student housing, which is a core focus for us, as well as retirement homes, which is not a focus for Centurion. And one of the reasons why we do like investing in apartments, because apartments and student housing has the ability to deliver both income and stability to the investor. Right. When you think about apartments, it is a need to rent industry, not a want to rent. And there is fundamentally a difference. A need to rent is someone who needs to have shelter over their head, and the only option at the moment they might have is renting. Whereas a want-to-rent investor could be someone who is maybe they're retired, they want to travel the world in retirement, they sell their home, and they decide to rent in an apartment building.
That's a strategic decision to rent.
Exactly. And one of the very uniqueness about apartments is that they're very defensive in nature. One of the reasons why the teachers' pension plan from Concordia looked at our apartment REIT is that they wanted to diversify their portfolio away from commercial and retail REITs in the public markets, because they tend to suffer what they call anchor tenant risk. If, for example,
yeah, you're talking about on the commercial side.
On the commercial, right? So if Target was to move out of your shopping mall or a Canadian Tire, the question is, how do you replace 150,000 square feet the next day? And the answer is you can't. Whereas with apartments, they're very defensive in nature. Whether the economy is doing well or in a recessionary period, people need a roof over their head. And even if we were to have one or two to five apartment suites out of 200 that are vacant, that's going to have next to no effect on our overall yield. In fact, we like when people move out because it gives us an opportunity to go in, renovate, and charge more on the next renters coming in.
Oh, I can't emphasize enough. I have two examples where I live. Number one, just down the road from us, I'm in Port Moody, just outside of Vancouver. There's a place called Coquitlam, and when Future Shop went, basically. Oh yeah, they just disappeared overnight. Remember that big announcement? All of a sudden, Future Shop closing all its doors. Well, Coquitlam Center, one of the largest shopping malls in this area, one of the huge anchor tenants was Future Shop. And just down the road was this large, very large Best Buy. The Best Buy basically decided to shut the doors on that and move into the shopping mall. Well, the Best Buy was in what effectively is a strip mall, and I drove by that the other day, and the place is just vacant and empty, and I thought, oh my God, I'm glad I'm not the landlord there. that would be a massive hit. And you would think, oh, we're solid. We got Best Buy, we got Future Shop. But there's an example where a shift in the economy can really impact the landlord. And if your REIT, and we saw that, by the way, in publicly traded REITs in the United States were really impacted from the subprime crisis. So I guess where I'm going with this is, if we had a housing crisis or a crash in our market, Al, I mean, now I'm thinking, worst case scenario, a subprime crisis scenario like what happened in the States. How would that impact you guys?
One of the things that Greg has always mentioned is that, a lot of investors tend to treat real estate as if it's one entity. But at the end of the day, condos aren't houses and houses aren't commercial buildings. I mean, you can actually have a slump in one that has little or no effect on the other, right? So if there was, for example, we're talking about this condo bust eventually happening, if you're a renter, if you're renting out a condo, for example, and like, for example, in downtown Toronto, you can rent out a 700 square foot condo, one bedroom, maybe a den for $1,800 a month. If all of a sudden, the market changes, the option you have, you can stay there and maybe not be able to afford it much any longer, but you can move into an apartment building where you can get a 2-bedroom apartment, 1,100 square feet for, $1,150 a month. So apartments tends to provide, so if there is a housing bubble or a condo bubble, at the end of the day, people no longer can afford their mortgages and they have a family. What options do you have? The option is you have to move into you have to become a renter until things improve.
I like the residential side personally. I own a commercial building and actually just recently sold it, but the interesting thing was, the thing that freaked me out, one of my tenants represented almost 1/3 of my rent, my income. If they just suddenly went bankrupt for whatever reason and vacated the next day, and it was like a restaurant, coffee shop, well, I'm not going to turn around and replace that within 1 month. We got TIs. I did the calculations. It would probably take me an entire year of lost income once I factored in finding a new tenant, and assuming we didn't even do change of use, I'd still have multiple TIs, tenant improvements to do. So it probably would cost me a year's income from that one tenant, which represented 1/3 of my total revenue from the building. So the exposure and vulnerability on the commercial side is quite significant. I like the fact that if somebody left overnight in the middle of the night on a 40-unit or 100-unit apartment building, probably going to rent that out within a month.
That's right. What's interesting about apartments is apartments tend to have one of the lowest risk profiles in the various real estate subsectors, but has historically generated the highest returns.
Interesting. And then you combine that, you can supercharge that with student rentals.
Exactly. I love the student housing. Yeah.
Well, there's a whole other subtext. So I'm on slide 11 here. Brian, tell me the difference between, like I mentioned earlier about some of the public REITs took a beating down in the States in the 2008 subprime crisis, et cetera. Also in January, when China basically devalued the yuan and the stock market crashed in China, I noticed that a lot of American-based and Canadian-based REITs went down in value. And some people on the line might go, well, I know a REIT that lost value in January and I lost some money in it, So this is a great opportunity to explain the difference between a public REIT and a private REIT. And just to clarify for those listening, Centurion is a private REIT.
Exactly. So, Peter, I strongly believe we are a lot more similar to a publicly traded REIT than we're different. However, there is some core differences. A publicly traded REIT like RioCan, Boardwalk, Callaway, for example, what publicly traded REITs provide investors is daily liquidity. So you can buy RioCan today and sell it tomorrow. It's linked to the market, so you do have daily liquidity. However, this daily trading also comes with a cost, and the cost is market volatility. Because I would like to believe that the value of RioCan is should be ruled the unit price of REOCAN should be based on true fundamentals. What is the underlying value of all of their properties in Canada? However, as we know with public markets, what really results in the price of a stock is investor sentiment, emotional investing. And so you can generally have, I take this with a tongue-in-cheek, but you can have a person in the basement sitting in their pajamas selling a stock and basically bidding up and bidding down that price.
Whereas, because essentially people are buying a stock.
Exactly. And so I would like to believe that, you know, when China did devaluate their currency, that it should not affect the value of our REIT, because by them devaluating their currency should not affect our renters in Guelph, Ontario, or in Halifax from making their monthly payments. And so when you look at a private REIT like Centurion, you can buy Centurion today, but you can't sell us tomorrow, but you can sell us within 30 days. So we do offer monthly liquidity. But because we are not linked to the public markets, we do offer a more rational pricing with lower volatility, and the value of our portfolio is actually based on fundamentals. It's based on the value of our 45 properties.
Right. So it's actually closer to a real value.
Exactly. And you can see at the bottom of this chart, it does indicate that, and actually, Peter, if you can turn to page 12, this chart actually illustrates, you know, a couple things about publicly traded REITs and market volatility. What this chart first illustrates is that the blue line is the S&P TSX Capped REIT Index, and the green line is the TSX Index. So right off the bat, you can see that, you know, real estate has outperformed the broader markets over the longer period of time. As well, you can also see that they move in tandem. They are very correlated to one another. And that correlation, you can definitely see the proof was in 2008 when the TSX was off 33%, and the S&P TSX Capped REIT Index was off 38%. It fell further than the broader markets.
And that had nothing to do with the actual valuation of the assets that the REITs were holding.
Investors wanted to get out.
Sentiment.
Yeah, they wanted to get out at all costs because it wasn't a great time in the first half of 2008. And so you can see the high level of volatility that you get with a publicly traded REIT. If you look at that chart in 2015, the TSX was down 8.3% last year. The REIT index was down 4.6% last year. Our REIT returned to investors a positive return of 10.2%.
So the bottom line here, folks listening, is that the difference between a public REIT and a private REIT is public REITs are exposed to the stock market. So it's correlated, there's that term again, correlate directly to the stock markets, because ultimately you're not buying real estate, you're buying shares in a company that buys real estate, and those shares are publicly traded, therefore exposed to the volatility of the stock market, as opposed to a private REIT will actually reflect the true value of the real estate assets it holds. So on that note, let's just skip to page 14 here. Let's dive in and talk, because I want to get onto the REOT here quickly. And what is what exactly is someone investing in when they invest with you? On slide 14.
On the REIT. So
on the REIT
essentially, as mentioned, the REIT is a nicely diversified portfolio of rental apartments and student housing that can be found across Canada. Investors, part of the strategy, will pool their funds and will invest in the portfolio and will participate in the yield from the rental income, because we are an income-driven product. So we're going to provide you the yield, as well as I mentioned before, we also want to provide you some growth. And we want to, as I mentioned, we want to grow our unit price between 2 to 5%. The objective of the REIT is to provide stable cash distributions that are paid out monthly, and we have never missed out on any of our distributions since day one.
That's impressive.
We've also like to provide tax advantage income. Essentially, because we were a REIT, KPMG, who is our auditor, they were just in our office a couple months ago, and they mentioned to us that our distributions in 2015 we were approximately 83% return of capital, which means we're very tax efficient. So return of capital.
Take a second. Sorry to interrupt. That's really critical for a lot of people on the line, because when we talked about the MIC last webinar, that is direct income, so tax at the highest level. That's why I suggested MIC is very good for very good to put into a what do you call a TFSA. But you said return of capital. Can you explain that a little bit?
Yeah. So what return of capital is that because let's say 83 cents of every dollar that we paid out, that 83 cents gets deferred until you eventually sell. And when you do divest or sell out of the REIT, your taxable disposition would be triggered as a capital gains, which is very, very tax efficient. So return of capital allows you to defer. I mean, we do have to pay the government at the end of the day. They always find ways of getting our money. So it's just a deferral mechanism to when you sell. So, for example, if we were to pay out $10,000 in distributions, 83% of that, or 8,300, you would not have to pay taxes in 2016, for example. We did have about 15.5% of interest income. So basically 15 cents of every dollar you earned would be taxable in the given year. So bottom line is you're keeping more money in your pocket.
But that means 85% of that is treated as return of capital. Therefore, you won't have to pay tax on that until it's treated as a capital gain on the back end.
Exactly, which is a lot more tax efficient than interest income. And that's why it's a really good investment solution for open money.
Wow, really important point there, because, you know, for some people you've got room in your TFSA. Well, great, you want an income-producing thing, and we'll talk about the REOT, could be excellent for that. But if you have open, and we talked about the term open, meaning it's not a registered money. You might have $150,000 or $100,000 that's not registered in RSP or TFSA. So now if you invest in something, you got to be really careful about not, you know, giving a huge chunk of it back in tax. This is a fantastic strategy of getting a return, but tax-efficient return. Brian, again, just for the sake of time, I'm going to just move along here to slides 15 and 16, and you know, the concept of the properties you look at. You're looking for undervalued properties. Can you touch a little bit on the strategy around the type of properties you guys purchase?
Sure. So our strategy is, there's three key points to our strategy, but at the end of the day, we invest in communities that are growing. I have a saying, we like to invest in communities where there's more people above ground than underground. And so we want a community where there's more people moving in than moving out.
I actually threw up a slide there of the diversification, the portfolio breakdown as well here, so people can see your Western Ontario breakdown.
Exactly, and I can go through. We are predominantly in Ontario. There's a strategic reason why we're there, but very quickly, we like to buy undervalued properties. We're value investors at Centurion. We don't like to overpay for buildings. So if we can identify properties that have untapped income potential, low vacancy, and stable tenant base, that fits our investment mold. And when we do invest into our properties, we stabilize our buildings. Sometimes they need to be improved, renovations, and all that does is that it results in these buildings becoming a lot more efficient in operating and in operating costs, and therefore we can generate a higher yield over time.
Which creates a growth opportunity for the investor as well.
You got it, because your buildings are worth a lot more. Now, that's when you buy older buildings, but we also love to buy newer buildings that are only being built in the last couple of years, because we don't have to put any capital expenditure into these buildings spread over 5 years. So the newer the building, the quicker the yield, the higher the yield we're able to generate out to the investors. And that's why we love when we can purchase a new building at the right price. That's what we're targeting. And lastly, in terms of our strategy, the REIT will be benefiting, will leverage off the REOT, because the Real Estate Opportunities Trust will mainly invest into deals that are of interest to the REIT. And so the REOT will be developing new apartments, and where the REIT will have a purchase option on. And Greg always wants to have control in everything he does, and so the REOT will provide pipelines of future deals where the REIT has a first right of refusal to bid on and hopefully secure for the investors in the REIT. It's a very unique strategy.
You know, that is I mean, absolutely unique strategy, and you know, it also creates a good segue because I mean, some people are listening online and say, "Okay, you lost me when you started talking about the REIT, the REOT. What are the differences between the two?" I skipped ahead to slide 21 here, and it just shows the growth of $10,000 invested in Centurion REIT since inception. Touch on that, and then I'd like to also maybe touch on this slide, Brian, and then talk about the fact that why you're currently not accepting any investments at this point in the REIT, and then we're going to jump in to talk about the REOT.
So this chart illustrates the performance of the REIT. As you can see, pretty, very strong numbers to, since we converted from a limited partnership in 2009. As I mentioned before, our returns in the REIT is a combination of both income and growth. And so, again, if we can target a yield close to 7% and grow our unit price between 2 to 5, you're going to have, I think, a positive experience with Centurion. In 2015, which was a very tough year for the Canadian market. If you could recall from the chart prior, it was down 8.2. We delivered a return of 10.2. We've actually outperformed the index by over 1,800 basis points.
That's
and
crazy,
you can see in 2014, we were up 9.2, very consistent. So our 5-year compounded return is just under 12% with no volatility.
Pretty impressive. It looks a lot different than the TSX chart that we showed earlier. Okay, so why can't we put money in this today, and where's that at? What's you're fully vested. You're fully you can't take money now, but explain that.
Okay, so we are very structured and disciplined in what we do with Centurion, and we're fortunate and blessed to be able to raise a lot of capital from investors, retail investors, and institutional investors. So it's great when you can raise the capital. However, you have to have the ability to deploy that capital and to purchase properties. Because if we continue to raise money and hold a lot of cash in our portfolios, that ends up diluting the unit holder's yield. And as I mentioned before, Greg's whole premise is capital preservation. And so Greg tends to open up the trust, when we need to raise money for possible investments. And when we, for example, are finding difficulty in looking for opportunities to invest, we will close it. So right now, the REIT was closed back in October 2014. We were raising a lot of capital, significant amount of capital, but we weren't investing because the acquisition market was very expensive. It was literally a bidding war. Greg and his analyst team would identify countless properties that we wanted to purchase. Unfortunately, it became an auction. Multiple bidders on the apartments, bidding up the price. And as I mentioned before, we're value managers and we'll never take part in any type of auction. So we basically closed the fund to investors in October. It sat on the cash as we built up our pipeline. And the positive news was in March, so we made an announcement to the street about 2 weeks ago that we were looking to reopen the REIT for a $20 million limited pool. And because we did purchase 2 buildings recently, both in Ontario as well, the REIT is an active investor in the REOT, so we also invested into the Opportunities Trust, therefore, using all the excess cash we had in the REIT. So we don't be surprised when we do close it. We're doing it to protect the unit holder. But I do believe we'll probably be closed for a possible another 2 to 4 months. 4 months on the I think on the long end, but hopefully within 2 months we will reopen again to accept new capital from investors.
And everything you just talked about, if everybody understood what you were saying there, that speaks volumes to the integrity, and that's the one thing that struck me when I met Greg and yourself the first time and listening to all this and educating myself. There was a lot of integrity behind the investment, because it's easy to just keep raising capital, and then the danger with some REITs, and MICs are the same, right? The danger is you might sit there and say, well, people are giving me money, so I'll just go, I got to buy something, and then you go out in the skinny branches, as I like to call it, you start investing or either lending money as a MIC or buying properties as a REIT into things that your spidey sense says, well, we shouldn't necessarily be doing this, but I got this money I raised, so I got to get it out. And the people who run businesses with integrity have no qualms about saying, sorry, we're closed. We're not going to take your money because there's not a good product out there. And it also gives me confidence, Brian, if you phone me and said, okay, we're going to open this up, and that might be 2 months from now, might be 4 months from now, that I can go to my investors, the people on this call, and say, okay, they're open. And if you're listening, that can give you the confidence to know that they're opening for a reason. They found a good product. And you know, you might sit there and say, well, geez, I was really excited. I like that, but what's this REOT thing he keeps talking about? So I think that's a great segue to say, you know, right now you're closed on the REIT, but you guys are accepting investments into the REOT, the Real Estate Opportunities Trust. So maybe talk about that for Will.
Sure. So as I mentioned before, one of the challenges we encountered that made us close the REIT was that you know, we were targeting great buildings, apartment buildings, brand new buildings, older buildings, but again, there was a bidding war. And a lot of times brokers were bringing us deals with 3 to 4 potential buyers behind them, and this bidding Centurion off the table. So Greg always, as I mentioned before, is all about control. So he thought about one day, what if I were to create a strategy that will allow the REIT to have a first right of refusal, otherwise a purchase option on brand new buildings, where we can actually you know, negotiate a price with a developer one-on-one, and that could possibly eliminate this bidding, this overbidding on properties. So we launched the REOT again back in October of 2014, and the major difference is a REIT acquires buildings, acquires student housing, whereas with the REOT, it is a lending/development strategy. So the REOT will, again, focus on capital preservation, growth, and income, but rather than buying apartments and student housing, the REOT will invest in a diversified portfolio of mortgages, very similar to a MIC. However, you as an investor have an opportunity for great for a good opportunity to generate capital growth, because with the REOT, you also have the ability to take part in these development deals as an equity investor. So we're lending money to the developers, as well we're taking an equity position in these development deals. So it is a true 1-2 punch. You're getting yield and you're getting the opportunity to generate growth.
That is actually quite fascinating, because it's something that is very unique, and it probably speaks volumes to Greg's intuition and his experience and his vision to create this type of vehicle. I mean, if I understand it correctly, we're getting a great income. You know, you create an income opportunity on the mortgage side, but then growth opportunity. So it's almost like combining a MIC and a REIT. And I'm actually on page 24 with the barbell. I mean, you can talk about the barbell strategy you like to talk about.
Yeah, so we're basically utilizing what they call barbell strategy. And really what a barbell strategy is, it's like a balanced fund in the mutual fund world. You got income you got equities on one side, and you got bonds on the other. So we're going to be using a barbell strategy for a balance between stability, income, as well as growth potential. So on the left-hand side of the barbell, a portion of the portfolio will be invested into mortgages for stability and interest earning. So we're looking to generate anywhere between 7 to 12% on our mortgages. And on the other side of the barbell is our, we'll be taking an equity participation in new construction developments for the capital growth component. And we're looking to generate anywhere between 15 to 25% on our equity. So on a weighted average, so right now, Peter, we are roughly 70% debt, so 70% mortgages,
Right. So 70% of that
equity.
income, 70% of my return will be income from a mortgage.
Well, actually, the way it's structured right now, exactly. So let's say 70. Well, we pay out a monthly yield of 6.97%. And
Okay.
so what that means is that if none of our buildings are sold in any given year, all you would receive is a nice, very attractive yield of say 7%.
Which
However,
quite often outperforms the market.
exactly. However, what I like about the REOT is that investors will not only participate in the yield from the mortgage interest income, they will also participate in the net profits from the sales of these completed projects. So when we do sell, either the REIT purchases the property or another buyer does, we have an opportunity to generate additional growth. So if we were to start to exit some of our development deals today based on a 70% debt, 30% equity, we anticipate we should be generating roughly about 12 to 13% weighted return. And so last year we had no exits because the portfolio was relatively young, but we returned 7.2% back to the investor.
Well, that's phenomenal. Yeah, and again, the 7.2% is going back to your baseball analogy, hitting singles and doubles consistently, and I think that's a great strategy. Tell me, who would be an ideal person for the REOT? If I'm an investor, why would I be looking at the REOT? What kind of profile would be your typical REOT investor?
Again, if you take a look at the cross-section of investors, they tend to be actually, it's young investors, pre-retired, retired investors that are looking for, again, stable monthly distributions. They're looking for more of a growth profile type of strategy because the REOT is more growthy, if that's a word, versus the REIT. As well, it's a great way if you do have open money. If you do have ability to add money into your RSPs or TFSAs, we're a good strategy for those types of vehicles. So really it's meant for those that are looking for growth and income. And what I love about the REOT is that you're getting paid every month. You're getting paid to wait. And then once we do have these exits in our development deals, you get to participate in those deals.
So let me ask you a question. We interviewed AP Mick last week, and one of the things we talked about was a great vehicle for your TFSA, for example. And of course, that's 100% just investment into mortgages and income. Somebody might look at this and say, well, it's a little redundant. I'm not really diversifying if I got Mick over here and a REOT also invests in mortgages. Just touch on why you think this might be a complementary. I mean, there's obviously similarities, but it also may complement and also diversify your investment strategy as an overall strategy to have both a MIC and a REOT.
I've always been a big believer in MICs and AP. I know those guys well, and I like their strategy and how they manage their MIC. So really what I like about our MIC is that, yes, we're investing into mortgages, in the portfolio. However, if you look at the breakdown, we are roughly 70% in multi-residential, so apartments and student housing. So right now, 55% of our assets, of our developments are apartment buildings, 15% are student housing. So you're still getting that multi-residential exposure. But because, remember, the name has opportunities, we also are very opportunistic in deals we're looking at. So the remaining 30% is split between some commercial and retail. And recently,
do you have a slide on that one?
It needs to be updated because it was saying 85%. It's near the end of the presentation. It would be on page, let me get it here, page 31. But you'll notice that this pie chart was saying 85% residential and 15% commercial. It has, we've been pretty active recently, so it's now roughly 70% residential and 30% commercial. But what I love about it is that I assume everybody knows those Essos / Tim Hortons gas stations on the corner of every street, the on the run. So Centurion has partnered up with a developer, a well-known developer that basically develops these on the runs, these Esso slash Tim Hortons entities. And so we went in there, we structured a first mortgage. We're basically lenders. It has been leased out. They're just looking for someone to fund these deals, and we're funding them. It's
I see these are Esso on the runs.
Esso on the runs, exactly.
So pretty low risk, I would say.
Exactly, because these properties are already being leased out, the agreements have been signed. They're just looking for someone to help on the financing of these properties. But you know, at the end of the day, I think what makes the REOT work, what makes it work, is that we have two key strategic partnerships, and that's very important, and I have to mention. So what we offer to developers is something unique that no other product is doing in Canada. Greg has built up a very strong pipeline of 15 to 20 relationship with developers across the country, and what we are offering developers is a true end-to-end solution. We're providing consultation to these developers on where to build, what to build. We're also providing the equity and debt financing, very similar to a MIC. But we're also offering the opportunity that they can hire us to lease up these buildings once they're complete, because developers, they have no idea how to fill families in these buildings. They can hire Centurion to do the property management of these developments. But the biggest benefit to a developer is that there is a built-in exit strategy for the developer. The fact that they know that Centurion is going to be at the end of the table putting in an offer, because we will have our first right of refusal on these developments once the deal is done. The development risk is greatly reduced, because the biggest risk for a developer is, I build my building, who's going to buy it? The fact they know that the REIT is well capitalized and has interest in these apartments and student housing, we greatly mitigate the risk in the REOT.
It kind of brings everything together, because you've got the lending arm, you got the development arm, you're able to attract the right developers. Greg and your team, their ability to identify these opportunities obviously is key, and the confidence we can have that in your abilities would be your track record. I've got the last slide up here showing the growth of $10,000 invested in Centurion REOT, which is relatively new, and that's important. It's only been around since 2014. This is a newer concept, but still a 7.24% growth since inception. So it sounds like you really integrated the best of both worlds here.
Exactly. And just we have an example on slide 27, Peter. I think it's 27. No, 27. This is an example, maybe to come to a closure with the webinar, but just to highlight how we deliver value to investors. In fact, I don't know, Peter, if you know this, TriView got us in front of this developer.
That's right. This is one of Craig's deals, right? Yeah.
That's right. So a developer was brought to us, and basically this is a development out in Edmonton. It's 100 units. It's 6 stories high. As you can notice, there's retail on the bottom. The developer never secured a first mortgage, so they came to Centurion. We did our due diligence on this project, and this is a project that we know that we want to purchase upon completion. So we actually took the developer to a bank. They needed a construction loan for $21.7 million. The bank ended up doing a first mortgage at 16.3. So there's a shortage of about $5 million. So Centurion put in a second mortgage, so we did a mezzanine debt loan of $2.5 million, and we got a mortgage loan interest rate of 11% on that 2.5, full collateral on against the developer and the executive, so we're fully protected. There was a shortage of $3 million. So this is a property that we like, and we want to take an equity position. So we put in 2/3 of the equity. So we put in $2 million of the 3, and the developer put in $1 million of their own. Now, as I mentioned before, again, it's all about mitigating risk. Greg does not like to lose money. So the point I want to make here is that Greg has already protected the investors on two fronts. One is when we like a property that we want to own, we feel very comfortable on taking a second mortgage position. However, if there's a development deal that we're working on that we have no interest at all in owning, like an SO on the run or a commercial building, for example, we will always take a first mortgage to protect our interests. As well, when we underwrite loans, we underwrite as if our partners are going to fail, which is our developers. We don't wish our partners to fail, but if our developer was to fail...
That, by the way, is a lending strategy. Every lender has to assume the person is going to default.
We feel more than comfortable on taking over the development, possibly paying off that $16.3 million with the bank, or continue to partner with them and see this project to the end. So if we can't make the numbers work, we don't invest. That's another way we kind of mitigate risk. And last but not least, we got a preferred return on this deal. We get the first 10% of all profits out, and then we split the profits 50-50 with the developers. Furthermore, the way we also protect our unit holders is we tend to register our equity as a debt, as a mortgage.
Right.
And so and as you know, debt holders rank higher than equity holders on the corporate stack. So if there's any pain to be felt, it's developers that have to put money in before we ever have to throw some money into the deal to cover the efficiency. And so we might give up some upside, but we're protecting our investors with a debt. And then remember, debt always get paid out. Bondholders always get paid before equity. And again, this
Greg's first rule is protect the money.
Don't lose money. And last but not least, we have a first right of refusal on this deal. So once this development deal is completed, the developer will approach Centurion and ask us if we're interested, and then the bidding, and then the discussion.
So you can sell this to the REIT.
So the REIT, it has a first right of refusal actually on this development deal. Now, at the end of the day, the developer doesn't have to sell it to the REIT. If they have an opportunity to sell it to anyone else, another potential buyers out there, but the point is that we can have first cracks at it, and because we've been good business partners with the developers, hopefully we have a great likelihood of buying this building.
So that's a great example right there of exactly how the REOT works. And Brian, you and I could go on probably for another hour, I'm sure. I'm just looking at the time here, and we are up on the hour, so I'd like to wrap up here. That is fantastic. One last little thing here. There was a question from Colin, not ignoring your question, Colin, about the tax implications. Just really quickly here, we talked about the REIT. We're actually payback as return of capital, therefore it's not taxed until on the back end it can be taxed as a capital gain. For the REOT, explain very quickly how that is taxed.
So the REOT, very similar to, because it's interest income, it's mortgage, we're generating interest income off our mortgages, it is predominantly interest income. So in 2015, our distributions were 95% interest income and approximately 5% return capital. So we were a little tax efficient, just marginally.
So 95% of that would be taxed exactly like a MIC. Therefore, if you're sitting there and you have access to, you haven't put anything into a TFSA and you're a couple and you have $93,000 a room, there's an example where you might want to split between a MIC and a REOT. Into your TFSA for tax efficiency there. And when the REIT opens up, if you have open money, well, that's a great place to put open money, i.e. not registered. Last question here, and we will wrap up after this. Minimum investment in the REOT is?
$5,000. It's a nice sized amount, $5,000. It's not 25, it's 5. Yeah.
Exactly. Listen, Brian, like I said, we can go. I love talking about this because, I've learned a lot tonight. Hopefully everybody else on the line has. Folks, if you have any questions, please do not hesitate to send me an email directly. Certainly, we do not have the scope and scale to answer every question that you might have on your mind, but hopefully we've answered most of them, and hopefully that's given you some more information about who and what Centurion Asset Management is. I just want to thank Brian Fraser for being on the line here tonight. Brian, that was fantastic. I think we all learned a lot. And lastly, I just want to remind everybody, if you have not done your personal financial landscape with me, send me an email and ask me for that form. There's a sheet that you fill out, we walk through, and as always, I offer a free half-hour, 45-minute consultation for you. That's a personal consultation to go over your current scenario, where you are, where you're going, and what your plan is to get there. Because as always, my goal is to help you accomplish yours, and in doing that, we got to look at the entire picture. We got to look at the holistic approach, so we know not just where you're going, but what vehicle's going to help you get there. So, Brian, thanks a lot for being on the line tonight.
Thank you. It's been a pleasure. Thank you for the opportunity. Good night, everyone.
Okay, thanks a lot. Folks, we'll be updating you on the next webinar once that is confirmed. I just want to thank everybody for being on the line, and again, as always, have an awesome night, and email me with any questions. Thanks, and have a great night.